Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market. From global macroeconomic trends to sovereign credit developments to regulatory and political changes.
Welcome to the latest edition of Fixed Interest podcast series. I'm Erich Arispe, Senior Director of Eastern Europe, Sovereign Ratings, and today I'm joined with Malgorzata Krzywicka, Director in our Sovereign team and also Lead Analyst for Hungary, and we'll discuss the outcome and rating implications of Hungary's April elections, where the victory of TISA's Peter Magyar granted the party a constitutional majority, raising the expectations regarding reforms, improved relations with the EU, as well as potentially adopting the euro. So, Gosia, maybe we can broaden first and look at Hungary's election on a regional context. We have had quite a few elections over the past couple of years in Central and Eastern Europe. Can you please help us understand what have been the main themes in these elections based on Fitch Ratings analysis, as well as get a sense of what the rating implications of these elections have been for the region?
Thanks for having me, Erich. And as you rightly pointed out, since 2023, the CE region has been through a very active election cycle. And in a number of cases, these elections have had clear implications for sovereign credit profiles, mainly through fiscal policy, reform momentum, and relations with the EU. Let me start with Poland, that actually opened the cycle with October 2023 parliamentary elections, which led to a government change and the formation of a three-party coalition led by Prime Minister Donald Tusk. Under the new government, the relations with the EU improved swiftly and Poland regained access to EU funds, which had been suspended due to rule of law and judicial independence issues. Domestically, the new government has faced a difficult cohabitation, especially since 2025 presidential election and a victory of a conservative candidate Karol Nawrocki. Since taking office, President Nawrocki blocked various economic policies and ruled out tax hikes and spending cuts. Pre-election promises of the new government and fiscal easing implemented ahead of 2023 vote contributed to a significant deterioration of public finances in Poland. Higher social spending, subsidies, public sector wages, and interest costs, coupled with a sharp increase in defense spending, contributed to fiscal deficit widening to 7.3% of GDP in 2025 from 3.4% in 2022, while public debt to GDP rose to almost 60% in 2025. Weakening public finances and political constraints were key drivers of Fitch's decision to revise the outlook to negative from stable on Poland A- rating in September 2025. Romania was another important case. Political uncertainty rose sharply at the end of 2024 after the presidential election was annulled due to alleged foreign interference, and parliamentary election produced a more divided parliament. That elevated political uncertainty with adverse effect on fiscal consolidation prospects, large deficits and rising debt were behind Fitch's decision to revise the outlook on Romania's BBB- rating to negative from stable in December 2024. Political uncertainty somewhat eased after the independent candidate Nicu Sordan won the second round of repeated presidential elections in mid-May, which paved the way for the formation of a four-party EU government led by Ilie Bolojan. The new government implemented a large fiscal consolidation package, which drove the narrowing of the fiscal deficit to 7.9% in 2025 from a very weak 9.3% in 2024. However, political uncertainty in Romania has resurfaced again in spring 2026 after one of the coalition parties left the government. In the Czech Republic, the October 2025 elections brought former Prime Minister Andrej Babiš back to power at the head of a coalition that is less committed to fiscal prudence. The new government has promised to increase social spending and reverse prior consolidation measures and pension reform that has been implemented by the previous government of Prime Minister Fiala. The near-term fiscal easing should be contained, but the pledge to cap the retirement age poses risks to long-term sustainability of the pension system and undermines the commitment to prudent fiscal policy, which has been one of the anchors of Czech Republic's AA- rating. Finally, the April 2026 elections in Hungary resulted in a decisive win for the opposition TISA, led by Peter Magyar. The party secured a constitutional majority with 141 of 199 parliamentary seats. TISA's constitutional majority has eased the risk of institutional clashes that could have undermined its ability to implement policy changes and has reduced the risk around transition of power. Nonetheless, the newly elected government will face significant macroeconomic and public finance challenges.
Thank you, Gosia. And now, taking a step back on Hungary, we revised the outlook on the sovereign rating, BBB, to negative last December. So maybe you can outline some of the factors that drove that decision, as well as how the elections in April influenced these factors.
Yes, so the revision of Hungary's outlook to negative from stable mainly reflected a larger than expected pre-election fiscal easing, rising government debt, and uncertainty over the post-election fiscal path and weak economic growth. Since late 2024, the Fidesz government introduced a broad package of pre-election measures, including higher family tax allowances, subsidized lending programs, public sector wage hikes, and the partial rollout of the 14th month pension. At the time of the rating committee, we estimated the cost of these measures at about 0.3% of GDP in 2025 and as much as 2.1% of GDP in 2026. Economic growth was weak in the run-up to the April elections, with Hungarian economy basically stagnating over the last 3 years. While the post-pandemic recovery has been driven by strong private consumption, investment contracted for 4 consecutive years. And that consumption-driven growth model is unsustainable over the medium term. The combination of wider deficits and projected modest growth outlook were behind our expectation that public debt will gradually increase over the medium term.
So the outcome of Hungary's election greatly reduced the risk of prolonged or heightened political uncertainty, and also the new government starts its mandate from a strong position with a constitutional majority. So, Gosia, what are understanding regarding the policy priorities and what are the main challenges facing this new government?
While TISA's key priorities focus on improving relations with the EU, strengthening the rule of law and governance, and unlocking EU funding, our main focus post-election is on assessing the credibility and feasibility of the fiscal consolidation strategy and how this consolidation will affect public debt dynamics, but also economic growth. The pre-election fiscal easing was likely higher than the pre-April 2022 parliamentary election package, with a larger share of measures being permanent, which complicates any future adjustment. The central government cash deficit widened to half 3.4 trillion after March, reaching 3.4% of GDP. That very large deficit reflects the cost of easing measures that have been implemented before, but also the new ones that were announced throughout the first quarter of this year, as well as an ad hoc energy support that has been implemented in response to the sharp rise in oil prices. It remains to be seen whether the new government will scale back measures introduced or announced by its predecessor. TISA has proposed a wealth tax, changes to corporate income taxation that could include cuts in subsidies to multinationals and reducing special sectoral taxes, and lowering tax for lower income households. All in all, pre-election promises, high debt service burden, and a difficulty to further reduce capex, which underpinned the reduction in deficit in 2022 to 2024, will increase the challenges for the new government to consolidate public finances. The incoming government will also face a challenge to rebuild fiscal policy credibility and strengthen the fiscal framework, after frequent revisions of budgetary targets and departures from stated fiscal policy objectives in recent years. The commitment to declining debt in line with the national fiscal rules has been inconsistent with the pre-election performance, as general government debt to GDP rose to 74.6% in 2025 from 73.3% in 2023. High and rising public debt level remains a key rating weakness of Hungary. One of TISA's long-term policy commitments, which could help anchor the necessary fiscal consolidation, is to adopt the euro, with the first step being the entry into the ERM2 mechanism. We would consider euro adoption as positive for the rating, as it would further strengthen external finance metrics. However, we currently do not incorporate that commitment into our baseline. Beyond the fiscal adjustment, the broader issue is whether the new government can rebuild a more sustainable growth model. Hungarian economy has stagnated since 2023 due to a combination of weak external demand, elevated uncertainty, and cuts in public capex that has negatively affected investment. Hungary also faces structural challenges amid stagnating labor productivity and deteriorating external price competitiveness. While we see growth recovering to just above 2% by 2027, supported firstly by pre-election fiscal easing and a gradual recovery of investment, and also new export capacities in the automotive and battery sector, Hungary remains exposed to the period of high energy prices. So the country is a net energy importer that also heavily relies on the EU growth, and that period of heightened uncertainty that we are currently facing could negatively affect the growth dynamics in the coming years.
Thank you, Gosia. On the point about the, let's say, complex relations that Hungary has had with the EU in recent years, resulting even in the freezing of cohesion funds as well as limited progress on the RRF facility, maybe you can briefly outline how has Fitch incorporated this relationship until now in our ratings, and what are the prospects or potential benefits from improved cooperation with the EU?
The EU fund inflows averaged only 0.7% of GDP in 2024 and 2025, well below 2.6% in 2022, which reflected ongoing rule of law proceedings and a lack of progress in meeting super milestones for RRF funds. Reduced access to funding has been reflected in Hungary's recent weak growth, especially of investment, and public finance deterioration. As I've mentioned before, investment contracted for 4 consecutive years, and at end 2025 were almost 18% lower than the pre-pandemic 4Q 19 level. The relations with the EU are likely to improve under the new government. Peter Magyar has taken a clearly pro-EU stance, and Tisza's supermajority will support the implementation of policy measures to address long-standing EU concerns around the rule of law, judicial independence, and corruption. More than 20 billion euro, or 8.5% of the Hungarian GDP, is currently unavailable to Hungary, with about a half in RRF grants and loans. Unlocking RRF funding will be key for the incoming government, as formally all necessary reforms and investment need to be finalized by August 2026, so time is very limited. Hungary has also requested 16.2 billion euro in loans under the EU SAFE mechanism, but National Defence Investment Plan has not yet been approved. Following October 2023 parliamentary elections in Poland, the European Commission unlocked the suspended funding in response to reform pledges that later stalled. While there seems to be an increased level of flexibility from the EU side, the Commission might be more cautious this time around in our view. However, Tisza's constitutional majority should make reform implementation easier than it has been the case in Poland post-elections. Negotiations between Magyar and European Commission began before the new government was formally sworn in. But it is important to keep in mind that we will have to see how quickly a full resumption of fund disbursement would translate into higher economic growth.
Thank you for sharing your insights, Gosia, and thank you all for listening. For more information on our ratings and research on Hungary, please visit us at fitchratings.com. We hope you will join us for the next edition of The Fixed Interest.
Subscribe to Fixed Interests wherever you get your podcasts.